Silver's move was even more dramatic. The metal had been rising faster than gold, reaching more than $120 per ounce last week, one of its strongest performances in decades. By Friday, silver had dropped sharply to around $98.50 per ounce. So what drove these rapid gains and what triggered the sudden pullback? More importantly, what should everyday investors understand about the risks of investing in precious metals right now? Gold has traditionally been viewed as a safe haven asset, attracting investors seeking to protect their savings during periods of financial uncertainty. Rising geopolitical tensions, renewed trade concerns, uncertainty around interest rate policy, and the possibility of changes in the global economic order have all increased demand for assets perceived as stable. The sharp decline in gold and silver prices on Friday was sparked by market reactions to early reports that Donald Trump had nominated Kevin Warsh as chair of the U.S. Federal Reserve. As the world's most influential central bank, changes in leadership at the Federal Reserve can have wide-reaching effects on global financial markets. At the same time, central banks around the world have continued to purchase gold at an accelerated pace, reinforcing its role as a long-term store of value during uncertain periods. Large institutions are not the only forces influencing the market. Retail investors, both in Australia and internationally, have also played an increasing role. Many individuals have turned to gold, silver, and other precious metals as a hedge against uncertainty, while others have been drawn in by strong price momentum. As prices moved higher, participation expanded further through exchange-traded funds, or ETFs, which allow investors to gain exposure to precious metals without the need to store physical bullion. While gold dominated headlines for much of 2025, silver became the standout performer. Prior to Friday's pullback, silver had risen more than 60% in just 1 month, far outpacing gold's gains over the same period. Unlike gold, silver serves both as an investment asset and an industrial metal. Demand from clean energy technologies, including solar panels, electric vehicles, and semiconductors, has become a major driver of silver prices. Each solar panel contains roughly 20 grams of silver, and the solar industry accounts for nearly 30% of global silver demand. Electric vehicles require between 25 and 50 grams of silver per unit, while the expansion of AI data centers has further increased demand for silver-based semiconductors. Adding to these pressures, the silver market has experienced a supply deficit for 5 consecutive years. Global consumption has exceeded production, and because most silver is mined as a byproduct of other metals, increasing supply is not a simple process. Retail investor participation in silver has risen sharply. One of Australia's largest online investment platforms, with approximately 3 million customers, has seen a significant increase in silver-related trading activity. Data tracking retail trades shows gold ETF activity increased by 47% over the past year, with cumulative net buying reaching $158 million. While silver attracted slightly less total investment at $104 million, trading activity in silver surged far more dramatically, rising by approximately 1,000% compared with the previous year. This indicates retail investors made more frequent, smaller trades in silver, a pattern commonly associated with momentum-driven investing. As a result, silver has increasingly taken on the role of the speculative component of the precious metals rally, while gold continues to serve as the portfolio anchor. Silver's lower per-ounce price, strong industrial demand narrative, and heightened visibility on social media have made it especially attractive to retail investors seeking exposure to the metals market at a lower entry point than gold. However, these trends also come with risks. Data shows many retail investors have entered the market as prices climbed, often driven by fear of missing out. This approach can expose investors to significant downside when markets reverse. Silver, in particular, is highly volatile. From February 2025 to its recent peak, silver prices rose approximately 269%, but that gain came with substantially higher volatility than gold. Silver's annualized volatility was around 36% compared with roughly 20% for gold. High volatility means rapid price increases can be followed by equally sharp declines, as seen in recent trading. Another risk is that precious metals do not generate income. Unlike stocks or bonds, gold and silver do not pay dividends or interest, meaning returns depend entirely on price appreciation from already elevated levels. For this reason, financial advisors generally recommend keeping precious metals to a modest portion of a diversified portfolio, typically between 5 and 15%. After the extreme price swings seen recently, maintaining that balance is more important than ever.